Good afternoon, everyone. My name is Jessica and I am currently working as an intern at ABC Financial Advisors. I am here today to give you a presentation on financial planning as a career choice so that you can have a greater insight into the financial planning industry, how your current studies can be applied in this field, and the recent developments you should be aware of in the industry. Prior to 2017, there were minimal restrictions on who could call themselves a financial planner and who could charge for financial advice. This allowed people who did not have any formal training in providing financial advice to charge people for such services, as well as allowing those who did provide financial advice to obtain financial incentives for providing misleading advice to their clients, leading to confusion amongst consumers and ultimately a mistrust in the industry. Then, in November of 2017, the Royal Commission into Misconduct in the banking, superannuation and financial services industry was held, concluding in February of 2019. It concluded that in the majority of cases examined, providers of financial services were failing to act in the best interest of their clients and instead acted in their own best interests. This Royal Commission made numerous recommendations, of which the majority were implemented by the government to reform the industry. These included financial advisory fees must be subject to annual renewal by the client and not automatically charged. All forms of conflicting remuneration to be banned for financial advisors, and financial advisors must have an approved qualification, pass an exam, complete 40 hours of CPD annually, adhere to the Code of Ethics, and complete a professional year of 1,600 hours of training and work activities. There are three main regulatory bodies that monitor financial advisors and ensure that they are meeting the standards set out by the Corporations Act of 2001 and the Corporations Amendment Act of 2017, also known as the Professional Standards of Financial Advisors Act. First, there's ASIC, which stands for the Australian Securities and Investment Commission. ASIC serves as the corporate markets and financial services regulator. Its primary functions include regulating financial markets and services, protecting consumers, investors, and creditors, and overseeing the registration and compliance of financial advisors. Next, there's FASI, the Financial Advisors Standards and Ethics Authority, which was established to elevate the education, training, and ethical standards for financial advisors. It developed educational qualifications, administered the financial advisor exam, and sets the codes of ethics, ensuring that advisors uphold the highest professional standard. This exam is now conducted by ASIC and is contracted out to the Australian Council for Educational Research to develop and administer the exam. Finally, there's APRA, the Australian Prudential Regulation Authority, which is responsible for the prudential regulation of banks, insurance companies, and superannuation funds. APRA ensures the financial safety and stability of these institutions, protects the interests of depositors, policyholders, and fund members, and monitors compliance with prudential standards and regulations. Together, ASIC and APRA maintain a robust regulatory framework, ensuring the high standards of professionalism, ethical behaviour, and consumer protection in the financial advisory industry. To offer effective financial planning advice, a solid understanding of the economic environment and financial markets is crucial. Financial planners need to stay informed about market trends, interest rates, inflation, and other economic indicators. This knowledge helps them make informed decisions and provide sound advice to their clients. Additionally, understanding the global economic landscape is essential as it can impact local markets and investment opportunities. Economic indicators are crucial for enabling investors to make well-informed decisions. By understanding and monitoring these indicators, investors can gain valuable insights into the overall economic environment, foresee trends, and adapt their investment strategies accordingly. Let's look at 4 key macroeconomic indicators. There's gross domestic product, or GDP, inflation rate, unemployment rate, and interest rate. GDP measures the total value of goods and services produced in a country and indicates the health of the economy. The inflation rate shows how quickly prices are rising, impacting the purchasing power of the population. The Having an employment rate indicates the percentage of people actively seeking work, reflecting economic stability. Finally, interest rates are the portion of a loan that is charged as interest to the borrower, usually expressed as an annual percentage of the remaining loan balance set by the Reserve Bank of Australia. Interest rates influence borrowing costs and investment returns. Macroeconomic indicators play a significant role in financial planning. For example, a rising GDP might indicate a strong economy, suggesting a favorable environment for investing in growth stocks. High inflation rates may lead planners to recommend assets that traditionally hedge against inflation, like real estate or commodities. High unemployment rates might prompt advice on more conservative investment strategies. And interest rates affect decisions on mortgage rates, savings accounts, and fixed income investments. Understanding these indicators helps planners tailor their advice to meet clients' needs and economic conditions. In conclusion, the financial planning industry in Australia is dynamic and evolving, with recent legislative changes aimed at enhancing professional standards. A deep understanding of the economic environment and macroeconomic indicators is essential for providing sound financial advice. For those interested in pursuing a career in financial planning, further study in financial markets, economics, and relevant professional qualifications can be very beneficial. Thank you for your attention.